Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
It's great to be here, and today we are unpacking what feels like a geopolitical earthquake that just hit. But the funny thing is, the epicenter wasn't anywhere near Wall Street.
No, not at all. It was in New Delhi.
Right.
If you were watching the global feeds yesterday, that's January 27th, 2026, you saw the champagne corks popping.
So, yeah.
India and the European Union have officially signed a free trade agreement. And look, I know free trade agreement is one of those phrases that can make your eyes glaze over.
It really can. It sounds so,
Right. But we need to be clear. This isn't just about shipping containers. This is about where the money goes next.
Exactly. This thing has been stuck in the pipeline for, it feels like forever. Years of negotiations, stalling, all that red tape, and then, boom, it's done.
To really get a sense of the scale here, I was looking for a good analogy. The one that stuck with me is this bridge versus highway idea.
Oh, I like that.
Imagine two massive economic zones, Europe City and India Town. For decades, they've been connected by this, rickety, single-lane wooden bridge.
Then a bridge with a very, very expensive toll booth on both ends.
A fortune, right. You cross it, you pay a fortune. Yesterday, they didn't just patch up a few holes. They basically tore down that old bridge and opened a 12-lane, high-speed superhighway.
No speed limits, no tolls, just flow.
Just flow.
It's a perfect way to put it. It's a total infrastructure overhaul for capital and goods. And while the handshake happened in India, our mission today is to figure out why this matters to you sitting here in the U.S.
Exactly.
We have President Trump in the White House, we have tariffs flying around in the news, and we have your portfolio to think about. This deal, it actually changes the gravity in the room.
Because capital is like water. Right. It just flows where there's the least resistance.
Precisely. And the resistance between Europe and India just dropped to almost zero. So we've got to do three things today. First, let's open the box. What do they actually sign? Second, we'll look at the sugar rush in the markets versus the reality. And third, the really juicy part, the geopolitical chess game with the U.S., Russia, and why Washington is giving this deal the side eye.
Let's start there, segment one. What's actually in the box? Because these deals are usually thousands of pages of, legal boredom. But there's a headline number that jumps right off the page.
90%. That is the magic number. According to the release, this deal eliminates tariffs on over 90% of goods traded between the two.
90%. That is aggressive.
It's almost everything.
It's incredibly comprehensive. The EU is wiping out tariffs on about 90% of Indian goods almost immediately. India's doing the same, but scaling up to cover 90% of EU exports over 7 years, it's a massive reopening.
Okay, but goods is such a generic word. Let's make this tangible. The research highlighted cars. I think this is the perfect way to show why that toll bridge analogy works so well. The car example is absolutely the best way to understand the friction that existed before yesterday. Up until this deal, if you were a European car maker, say, in Germany, and you wanted to sell a car in India, you were hit with a basic tariff of up to 110%.
Wait, stop there for a second. 110%. So let me get this straight. If I make a car for $40,000, by the time it lands in a showroom in Mumbai,
it's nearly $85,000, and that's before any dealer markups or local taxes. You are essentially buying one car for yourself and then buying another whole car just to pay the government.
which means basically no one buys the car unless they have money to burn.
Exactly. It made European cars a pure luxury item for the ultra-rich. It was a prohibitive wall. It didn't just slow trade, it stopped it for the average person.
And under the New Deal, what does that wall look like now?
Well, the wall comes down. It's not, vanishing overnight. Governments never do anything overnight. But the deal brings that tariff all the way down to 10% over the long term with some quotas.
From 110% down to 10. That is not a discount. That changes the entire business model.
It allows European manufacturing to actually compete for the Indian middle class, not just for the billionaires. And it's not just cars. Think heavy machinery, precision equipment, pharmaceuticals, chemicals. It's a grand reopening of the Indian market for Europe.
Now, there was another term in the fine print that kind of jumped out at me. Mobility. In the current political climate, 2026, borders are tightening. That word usually sets off alarm bells. Is this a migration deal?
This is where we have to be really, really specific with the language, because the politicians certainly are. The analysis highlights a mobility of professionals clause, but you have to separate migration from mobility.
So we're not talking about green cards.
Yeah.
Or citizenship.
No, not at all. The European Commission was very clear about this. It's not about permanent residency. It's about what trade negotiators call mode 4 service delivery.
Mode 4. Okay, translate that for us.
So think of an IT consultant in Bangalore. A German company needs her to install a new system in Berlin. Before, getting that consultant into Germany for, say, 3 months was a nightmare of paperwork. Mobility creates a fast track.
So it's frictionless business travel, basically.
Exactly. You fly in, you do the project, you fly out. It facilitates the service, not the settlement. It really shows you how modern trade deals work. It's not just about shipping steel anymore. It's about moving data and talent.
And speaking of steel, the notes also mention this isn't just about money. There's a strategic partnership label on this. That sounds like military talk.
It is, and this is where we start zooming out to the big map. The EU isn't just looking for a new place to sell cars. This deal comes with an EU-India security and defense partnership. They're elevating India to a strategic axis.
A strategic axis against who? You don't usually need an axis unless there's a rival.
Well, just look at the map. You've got China to the east, Russia to the north. The EU is realizing the world is getting a bit more dangerous. They're trying to diversify their friends. But to understand why, we have to look at the money first.
Right, okay. Let's go to segment 2, the market reaction. Because Wall Street, or I guess Dalal Street in Mumbai, votes with its wallet, and the charts yesterday, they did a little victory lap.
They did. The Sensex, which is the Indian benchmark index, it popped about 500 points right after the news broke.
500 points. That sounds like a lot. Was that just investors popping their own champagne?
It was a celebration for sure. The optimism is really driven by this projection that trade could hit $250 billion by 2031. That's a massive number. But, and here's the reality check, you have to distinguish between a sugar rush and, a full meal.
Okay, explain the sugar rush. If I see a 500-point jump, am I wrong to think the money's here?
You're not wrong, but you might be a little early. What we saw yesterday was a re-rating.
Re-rating. That's a term we hear a lot. Break that down for someone who's not a financial analyst.
Okay, so think of it this way. A stock price is just what investors are willing to pay today for a company's future profits. Yesterday, no new cash suddenly landed in these companies' bank accounts.
So the earnings didn't change, but the belief in future earnings did.
Exactly. Investors just said, okay, we're willing to pay a higher price for these stocks because the future looks safer and a lot more profitable. It's a psychological shift, not a cash flow shift. Not yet, anyway.
So it's a vote of confidence. It's, we believe the highway is open, so we'll buy the car now in anticipation.
Correct. And the logic behind that confidence is this win-win scenario they're talking about.
Wait, just break that down. Usually in trade, someone complains they lost.
Well, in this specific case, the puzzle pieces just fit really well. For India, the win is what analysts are calling the spare engine.
A spare engine?
Yeah. For the last decade, India has been trying to become a manufacturing hub, right? Make in India. But to do that, you need someone to buy your stuff. If the U.S. economy slows down or if President Trump puts up a tariff wall, India needs a backup buyer.
So if the American engine sputters, they can just fire up the European one.
Precisely. And for the EU, they get access to 1.4 billion people. Europe's own population is aging, their domestic demand is kind of flat. They need a young, growing consumer market. India is that market. But again, this all sounds a little too perfect on paper.
And we don't live on paper, we live in 2026. Which brings us to the elephant in the room. Or rather, the elephant in the Oval Office.
Segment 3, the geopolitical chessboard.
We have to talk about the context. Donald Trump is president. The global mood on trade is, well, tense is a polite word for it. Tariffs are the weapon of choice. How does this deal fit into that world?
You really can't understand this deal without looking at Washington. Recent analysis suggests a massive motivation for the EU to finally close this deal. Remember, they dragged their feet for years, was to hedge.
Hedging against the U.S.
Yes. The EU can read the room. They know the current U.S. administration is all about protectionism, America first. They're worried about getting squeezed. So by locking in India, the EU reduces its reliance on China, which is politically messy, and it creates a buffer against potential U.S. economic pressure. They're building a survival kit.
That makes sense for Europe. Don't put all your eggs in the American basket. What about India? They seem to be making friends with everyone lately.
India is playing a very, very sophisticated game here. We can call it the balancer strategy.
The balancer.
Think about leverage. If India goes to negotiate with the U.S. and they have no other options, they have to take whatever deal Washington gives them. But now they can sit down and say, look, we'd love to trade with you, but we just opened a 12-lane highway to Europe, so give us a good reason to look your way.
It's classic negotiation. It's like dating, right? You're more desirable when everyone knows you have other dates lined up.
That is a surprisingly accurate way to describe high-level diplomacy.
Yes.
It creates a fear of missing out for U.S. negotiators. But the U.S. reaction itself has been fascinating. It's not one voice. It's almost like a game of good cop, bad cop.
Ooh, I like this. Wait, who's playing the good cop?
That would be Jamieson Greer, the USTR, the top trade negotiator. He came out and basically admitted that India won this deal. He looked at the terms and said, India got great market access. They got the visa mobility. Good for them. He was pretty neutral, almost impressed.
So he's the respect the game cop. You got a good deal, I see you. Who's the bad cop?
Scott Bessent, the Treasury Secretary, his tone was much sharper, much more pointed. And here's the twist. He didn't complain about cars or tariffs. He linked this trade deal directly to the war in Ukraine.
Whoa, wait a second. How do you get from an India-EU trade deal to the war in Ukraine? That feels like a stretch.
It's the oil. Here's the connection he made. India continues to buy huge amounts of Russian crude oil. They refine it, they sell it. Bessent's argument is, Europe, you say you support Ukraine, you say you want to crush Putin's war machine, yet you just signed a massive economic deal with the one country that is bankrolling Russia's economy by buying its oil.
I see. So the U.S. is calling out what they see as hypocrisy. You're shaking hands with the guy who's paying your enemy.
Exactly. And the pressure point is crystal clear. The Treasury Secretary hinted that the U.S. might ease up on India, maybe on U.S. tariffs, if India starts to reduce those Russian oil imports.
That is an incredibly tightrope for India to walk. Congrats on your new highway, but we're watching what you put in your gas tank.
Precisely. And this is why, as investors, we can't just look at stock prices. We have to look at the politics.
It's all connected, which brings us to the part our listeners are waiting for. Segment 4. Investment takeaways.
The so what?
Exactly. I'm sitting here in the U.S. I'm a beginner investor. I see this headline. Do I buy, sell, hide my money under the mattress?
Well, please don't do the mattress thing. Inflation will eat it for lunch. Let's look at this rationally. We have 3 main takeaways here.
Okay, hit me with number 1.
Takeaway 1 is, look at the fine print, specifically the green fine print.
I'm guessing this has to do with climate change.
It does. The deal is not a free pass. There's a mechanism called CBAM. CBAM, the Carbon Border Adjustment Mechanism.
CBAM. Sounds like a sound effect from a comic book. CBAM.
It's definitely a villain for high-carbon industries. Think of CBAM as a border guard who doesn't check your passport, he checks your smokestack. So even though the tariff is 0, Indian companies, especially steel and aluminum makers, they still have to pay a carbon tax to enter Europe if their production methods are dirty.
So that 90% tariff reduction we were celebrating comes with a big asterisk.
A very big one. It's a hidden cost. So if you're looking at Indian export stocks, you need to calculate this. An Indian steel company might look great because of the FTA, but if they have high emissions, their profits are going to get eaten up by CBAM. The lesson is, don't just buy India exports. Buy clean India exports.
That's a great tip. The devil's in the emissions. Okay, what's takeaway number 2?
Takeaway 2 is the European opportunity. We're focusing on India, but European companies are huge winners here too.
Right, like the car makers we mentioned.
Yes, but think even broader. European industrials. Companies in Germany, France that make heavy machinery, specialty chemicals, precision tools. They've been squeezed by slow growth at home and tough competition in China. Now they have a protected, preferential lane into the fastest growing major economy in the world.
So if holding a European ETF for a fund that tracks the German market, this is good news.
It is. It gives those old school industrial giants a new growth story. They have a new place to expand when the U.S. market might be getting harder to get into because of Trump's policies. Don't sleep on the old world.
And what's takeaway number 3?
Takeaway 3 is what I call the basket strategy.
Okay, explain the baskets. This sounds like how I do my laundry, but I'm guessing it makes more money.
Hopefully. A lot of beginner investors see a headline like this and just think, I should buy an India index fund. The problem is an index has everything, the good, the bad, the exposed. You need to separate companies into baskets based on where they sell their products.
Okay, give me the baskets.
Basket A, companies that export heavily to the U.S. Think IT services, generic pharma. These are actually risky right now because of the potential U.S. tariffs and that whole friction over Russian oil. This EU deal doesn't help them at all.
Right. So basket A is the caution basket.
Exactly. Basket B, companies that export to Europe. Textiles, auto parts, leather goods, these are the direct winners from yesterday's deal. That's your growth basket.
And basket C.
Domestic companies, banks, real estate, companies that just sell to Indians in India. They're insulated from trade wars. They don't care about tariffs in Washington or Brussels. They care about the monsoon and local interest rates.
That is really smart. So diversification isn't just about buying different stocks, it's buying different geopolitical risks.
That's it exactly. If the U.S. clamps down, your Europe basket might protect you. If Europe slows down, your domestic basket is your safety net. Don't just buy the India blob.
Understand what's inside the blob.
Right, or at least understand the index is being pulled in different directions. It might go sideways because the U.S. exporters are down while the EU exporters are up.
This has been incredibly helpful. We've gone from a toll bridge to a superhighway, we navigated carbon taxes, and dodged political crossfire.
It's a fascinating time for global trade. The old rulebook is being thrown out.
Before we wrap, we always like to leave our listeners with one final thought, something to chew on.
Here's my thought for today. We often think the winner in the global economy is the country with the biggest GDP or the biggest army. But in this new world of tariff wars and protectionism, I think the rules are changing.
How so?
I think the winner isn't the biggest economy, but the country that secures the most backup plans the fastest. Europe and India just secured a massive backup plan for each other. They built a detour around potential roadblocks. So the question for you as an investor is, does your portfolio have backup plans? Or are you stuck on a single-lane bridge waiting for a toll booth that might just get more expensive?
That is a powerful thought. Are you diversified enough to survive a roadblock?
That's the question.
Well, on that note, we're going to wrap it up. Thank you so much for breaking all this down for us.
My pleasure.
And thank you for listening. We hope this cleared up the headlines. Don't forget to subscribe and hit that like button. We'll see you in the next deep dive.